Hello, this is Robert Dumas from TaxConnex. Welcome back to our discussion of the five-step process for sales tax compliance. To recap, the five-step process includes 1. Determining whether or not your business has nexus and in which states you have nexus. 2. The taxability of your services or products in the states you have nexus. 3. The prior period exposure you may have for tax liabilities uncollected and unremitted in those states. 4. A plan for mitigating and minimizing those liabilities, those prior period liabilities specifically. And 5. An implementation plan, an action plan on the 4 previous steps. Today we're going to talk about the second step, which is taxability. If you have nexus in a state, as I said in the previous video, that state has the power and authority to require you to collect their sales tax. Consequently, you're going to have to know how that state taxes your products and services. Generally, tangible personal property is subject to sales tax. Generally, services are not subject to sales tax. Now that we have those generalities out of the way, you have to be aware there's always exceptions. Sales tax laws in all 50 states involve exceptions. And you may have one exception in one state that does not apply in another. So never assume one state's rules apply to another state's rules. Let's talk specifically about taxability issues on certain industries. For example, contractors. In some states, contractors are retailers and have to collect sales tax. In other states, contractors are subject to consumer's use tax in those states. You have to be able to distinguish the difference and your responsibility under both scenarios. Technology companies. This is an area ripe with confusion, not only from the industry itself, but from the states. Technology is advancing much faster than state statutes. So the determination of whether or not your technology service is taxable is sometimes very gray. Today, we have electronically downloaded software. We have digital versus analog. We also have software as a service. Many of the state statutes do not define this specifically. So you have to navigate very carefully in determining the taxability rules if you're a technology company. The third industry I'm going to talk about briefly is telecommunications. Though telecommunications is viewed by you and me as a service, it is generally a taxable product in most states. What makes it so different is it's not only subject to sales tax, but in some states there's additional gross receipts taxes and or excise taxes that may apply. So you can't just assume that only sales tax is an issue for you. There could be other tax types you need to be aware of. As I mentioned previously, the rules from state to state vary greatly. You can't control that. There's 50 state legislatures, 50 state governors, all with their own objectives relative to revenue for their states. So you have to be very careful when you're making that assessment on a state-by-state basis. Where do you go to get this information? Well, you can license what we call content. There are businesses out there that keep statutes, regulations, private letter rulings for all the states. You can license that content and do the research. Alternatively, you can get some information by just doing Google searches on the web. The third alternative is to use a tax geek like me and the others I work with at TaxConnex, and we can help you determine taxability. One thing to note as well, this five-step process, your vendors are also going through. If you have a vendor that has determined they don't have nexus in your state, they're shipping goods to your state that are otherwise taxable, even though they didn't assess and invoice you for sales tax, doesn't mean you're not liable for it. You have consumer's use tax. So be careful that you're paying use tax on any items you receive from vendors that aren't charging you sales tax. Join us next time when we talk about how to calculate and determine your prior period tax liability, if any. Thank you.